When I started trading initially, the journey was not easy for me. Mostly because in the world of stock market, there are so many difficult terms and words. I couldn't understand them at all. And I know the journey is very similar for you as well, right? You should know all the basic but common terms which are used in the world of stock market, and that's exactly what we are going to do in the video.
So, first things first, let's define what an altcoin is. An altcoin is a term used to describe any cryptocurrency that is not Bitcoin. Bitcoin is the first and most well-known cryptocurrency, but there are thousands of other cryptocurrencies available in the market, and all of them are considered as altcoins. Now, you might be thinking, why do we need altcoins when we already have Bitcoin? The answer to this question lies in the fact that altcoins have certain advantages over Bitcoin. For instance, some altcoins are faster, cheaper, and more scalable than Bitcoin. Additionally, altcoins are known for their unique features such as privacy, security, and governance, which Bitcoin lacks.
HODL is a term that started out as a meme back in 2013 when a user misspelled the word hold on a cryptocurrency forum, stating that he is hodling after a market crash rather than selling. Since then, it became perhaps the most popular term in the crypto world, with many enthusiasts swearing by their strategy of simply buying and hodling rather than trying to time the unpredictable market. The pros of this strategy are: 1. For crypto, it worked so far. For example, even those who bought Bitcoin at the worst possible time during the bull market, which peaked in 2013, could have sold for roughly 17 times more at the peak of the following bull market in 2017. 2. It gives people peace of mind, with many choosing to simply buy through dollar cost averaging, then sit back and relax. The cons, however, are: 1. Past performance is not indicative of future results. In other words, hodling might have proven to be a great strategy thus far, but this doesn't mean it always will. 2. While dollar cost averaging is a popular strategy in the crypto world, it tends to be considered inferior to lump sum investing by specialists. 3. Even the peace of mind dimension is tricky, since hodlers would have had to hold on to their crypto during even 85% plus crashes. What if they all of a sudden needed money for things like huge unexpected medical expenses? All in all, while there's nothing wrong with believing in crypto and choosing not to actively trade, you shouldn't let your affinity toward hodling keep you from putting together a reasonable money management strategy.
FOMO refers to the dread that a trader or investor experiences when losing out on a potentially profitable investment or trading opportunity. A trader's fear of missing out grows as the market continues to behave irrationally and rises dramatically in a relatively brief period of time. FOMO occurs when a trader fears missing a big market opportunity. New traders with retail trading accounts and expert traders at large institutions might feel FOMO in financial trading.
What is an ICO? An ICO, or initial coin offering, sometimes also called a token sale or initial token offering, is a practice of crowdfunding for blockchain projects, where a cryptocurrency or token is offered to early investors before being listed on a wider marketplace, such as exchanges. ICOs are high-risk investments, so caution is advised when investing. That's why the most important aspect of participating in any ICO is doing extensive research around the project. This includes reading the white paper, working out whether the ICO provides real-world value, and researching the team in detail. To participate in an ICO, you need to own the relevant cryptocurrency that the ICO is accepting as investments. Make sure that the cryptocurrency wallet that you are sending the funds from is compatible with the ICO token. Triple check the deposit address from official sources.
What is hash rate? Hash rate refers to the total combined computational power that is being used to mine and process transactions on a proof-of-work blockchain. Hash rate is a measure of the computational power per second used when mining. More simply, it is the speed of mining. It is measured in units of hash per second, meaning how many calculations per second can be performed. Machines with a high hash power are highly efficient and can process a lot of data in a single second. In the case of Bitcoin, the hash rate indicates the number of times hash values are calculated for PoW every second.
What is fiat money? According to the Oxford Living Dictionaries, a fiat is a formal authorization or proposition, a decree. All national currencies today that are in circulation and that central banks issue and manage are fiat currencies. Fiat money or fiat currency is any money that the government declares as legal tender. In other words, the money must be accepted if offered in payment. Fiat money is not backed by a physical commodity such as gold or silver. The image on the left shows a $10 bill. This is an example of fiat money. The $10 bill is worth $10 because the US government says so. Fiat money has no intrinsic value. The paper of a $10 bill is virtually worthless. Ultimately, market forces determine the value of fiat money. In other words, the forces of demand and supply determine its worth. So to recap, fiat money's value comes from government decree, an official order that has the force of law, and then its value is influenced by market forces, which are supply and demand.
Whale. Example, there must be a whale behind this coin's movement. A whale is someone who owns a lot of cryptocurrency, Saddington says. According to statistics and the addresses that you can find online, because Bitcoin isn't truly anonymous, you can actually find the whales. These are the people who own a ton of Bitcoin. We're talking about like hundreds of thousands of Bitcoin or more. If a whale sells a lot of their stake, it can cause the price of a cryptocurrency to dip by flooding supply, he explains. ATH, all-time high, is used as an abbreviation by writers to describe when a certain cryptocurrency, or the entire market, traded at its highest price. Bitcoin hit an ATH of $64,805 on April 14, 2021. Ethereum hit an ATH of $4,356.99 on May 12, 2021. The entire cryptocurrency market hit an all-time high of $2,577 billion on May 12, 2021.
FUD is an acronym for fear, uncertainty, and doubt. And if you couldn't guess by the name, it is used mainly in crypto news and even the stock market to emotionally manipulate people into selling their crypto holdings. You've probably seen hundreds of headlines that Bitcoin's a bubble or the government is banning crypto sales. These types of headlines are what we call FUD. While there may be a little bit of truth behind them, they are usually spun to try to strike on the worst case possible. Let's take a headline that I saw the other day. It mentioned that the UK was banning trade on Binance. And while that is fine, and there is maybe some truth to it, the article started talking about this move being the downfall of crypto and how you should have all of your money in fiat currencies. Now yes, some currencies are cracking down on Binance, and this is a whole nother video. But it is not logical to abstract that fear from one coin to an entire industry. It is not a reason to sell all of your crypto. Let me explain. You should base your selling position on what you believe the market is doing and how much you believe in a project itself, not off of headlines. Headlines are good sources of information, but writers are usually incentivized to write clickbaity titles that churn readers. We found time and time again that emotional headlines get more clicks than boring ones.
What is a token? Tokens must not be mistaken with cryptocurrencies or altcoins. Tokens and altcoins are subsets of cryptocurrencies. Tokens are a type of cryptocurrency that are used as a specific asset or represent a particular use on the blockchain. They are sometimes created through initial coin offerings, ICOs, or other fundraising methods including initial DEX offerings or IDOs.
What is stablecoin? Stablecoins are a cryptocurrency whose value is fixed or tied to that of another currency. Its primary goal is to provide an alternative to the significant unstableness of the most famous cryptocurrencies, such as Bitcoin, making crypto investments less fitting for basic transactions. Stablecoins are after price stability through maintenance of reserve assets as collateral or using algorithmic formulas for controlling supply. There are a few types of stablecoins according to the mechanism used in stabilizing their value. Fiat collateralized stablecoins maintain reserves of fiat currencies, like the US dollar.
What is P2P trading? One of the most popular ways to buy cryptos is through a method called peer-to-peer or P2P trading. A P2P trade carries out between individuals. Buyer sends fiat payment directly to sellers who hold that digital currency, and the seller releases the digital currency to the buyer. Since the purchase of cryptos is carried out between users outside of the exchange rather than by making trades on the exchange, the purchase of cryptos using fiat currency is also referred to as peer-to-peer or P2P trading.
Pump and dump. Example, this coin's chart looks like it was a pump and dump. Pump and dumpers are people who often say, hey, let's all of us together pump this coin, which means buy the coin, create the demand in the market, the coin will go up in value, Saddington says. Then, everyone dumps the coin and sells. These schemes are often orchestrated through apps like Slack or Telegram, he adds, and advises curious chat room readers to beware of such gimmicks. An investigation into pump and dump schemes by Business Insider found the practice to be an open secret among many cryptocurrency traders.
Yield farming is pretty self-explanatory. It basically describes the act of investors trying to maximize their returns, or yield in DeFi, by putting their assets to work on different protocols. For example, yield farmers can deposit assets into DEXs like Uniswap or lending platforms like Aave to help facilitate trades and loans. And in return, they are rewarded with a portion of the platform's fee or interest paid by borrowers.
What is a cryptocurrency wallet? Simply put, a crypto wallet is a tool you can use to interact with a blockchain network. The various kinds of wallets can be divided into three main groups: software, hardware, and paper wallets. But depending on their working mechanisms, they may also be referred to as hot or cold wallets.
The first type of wallet you can put your currency into is a software wallet. Now, these wallets are usually online based. Exchanges like Coinbase or Binance are great examples of a software or online based wallet. The public and private keys are stored on their servers, and they let you access them through your account. Now, it is important to know that they could technically spend your crypto because a private key or the password is on their servers. Next up, we have a hardware wallet. So if you don't trust your information with a company or being online in itself, you can actually opt into using a hardware wallet. These wallets are basically USB sticks that store your public and private keys for you. You can unplug them, and then basically no one has access to them. Now, these wallets usually have a very secure process of getting into them. For example, the Ledger Live uses a 24-key phrase system to enter into its system, and there is no recovery process if you forget them. For example, if you forget those 24 phrases, your crypto is gone forever. But this is a double-sided sword though. Nobody is going to be hacking into your crypto unless they get access to the ledger and know the password to get into it. One thing to know here is that these physical devices can start to get a little bit pricey. I actually bought mine for around $90 a few months ago. Finally, we have a paper wallet. So the last wallet you can use for crypto would be a paper wallet, and this wallet would consist of your private and public keys and maybe QR codes that are used to facilitate cryptocurrency transactions. Basically, your public and private keys are literally written down on paper. You can think of this like using cash to debit cards. Though one of the largest problems with this method is the ability to lose or destroy the piece of paper if on purpose or by accident. Now, this is the most secure way to store your crypto, but it's also the least practical, which means you should really only use this if you have a large sum of money that you want to protect but not access it very often, because you'd be typing in that private key every time you want to make a transaction.
What is a decentralized exchange? A decentralized exchange or a DEX is a place where people can go to trade cryptocurrencies without any intermediary. So let's look into them first. Well, a centralized exchange such as Binance or Coinbase is a place where people can buy, sell or trade cryptocurrencies and tokens listed on that exchange. Now, let's say you want to buy some Bitcoin. Then you need to go to exchange, sign up by providing some banking details and identifying information, and deposit some cash. And sometimes this process takes days, which accounts as one of the major drawbacks of centralized exchanges versus decentralized exchanges. Now, such exchange will tell you the price based on an order book of people buying and selling at different amounts, and you can make the transaction as per your convenience too. What happens next? Well, once you make a purchase, the exchange will show those bitcoins in your account, and you can trade for other tokens on the exchange. Are you feeling amazing that you've earned your bitcoins? Well, actually you don't really hold them, because you're entrusting the exchange to act as a custodian on your behalf. And any trading you do, like swapping bitcoins for Ethereum, aren't occurring on a blockchain, but within the exchange's database.
What is a fork? In the development world of programming, a fork is an updated or new version of code that is simply old code that has been changed a little bit. In the sense of crypto, a fork could refer to two potential ways that a blockchain could continue. It's basically a change in protocol. However, we can categorize these two forms of changes: soft forks and hard forks. Let's go over them real quick, and then we're going to talk about which one is better and which one may be more dangerous. A soft fork doesn't require the miners to do anything different. They can keep mining in the same fashion that they have been, and they don't have to do anything. Nevertheless, the intended changes will be made. This would be like if your parents got divorced. As a child, you don't really have to do anything. You just continue living your life under a new set of rules. Next up, we have a hard fork. Now, a hard fork does require the miners to do something, whether it's updating their software or change some number in the software or some other internal action. A miner must make changes to continue contributing to the network if a hard fork happens. Now, the idea here is that the old blocks are so different from the new blocks that the miner's old software can't work with it. It's kind of like if you buy a new car. You probably have to get a new key. The old key just won't work, and it might not even fit. It may be even a completely different type of key depending on how old your car is. In a similar manner, a hard fork changes the block structure in a manner that requires all the people participating in the network to intentionally make a change to continue mining. A smart contract is exactly like this. It's a piece of code that does something if something else happens. A lot of people call it if this, then that. The most common smart contracts are written on the Ethereum network using something called Solidity. So let's go over some examples of purposes of smart contracts. You could write a piece of code that says, if you give me 5 Ethereum, in turn, I will give you 20 basic attention tokens. If you have at least 100,000 subscribers by the end of the year, 20 Ethereum will be added to your account. And if the temperature is over 95 degrees for more than 4 days in a row this year, Farmer John's account will receive $100,000 as crop insurance. Now, it would be really easy to write a smart contract where people could donate Ethereum to a certain address. And then if that contract address reached a certain point, maybe say 500 Ethereum, then we could give each donor a portion of an online work, such as an artistic NFT, or access to read an online book, or even join a community. The purposes of smart contracts are endless. But when it comes to smart contracts, there are two main things that you need to know that makes them beneficial to everyone. Number one, they are immutable. This means they cannot change. So you remember how I said some people call them if this, then that? It's because most smart contracts do something when they get triggered. They are basically just code on the blockchain that gets ran. And once it's on the blockchain, it can never be changed. Now, the downside of this, you might be thinking, is that if there is a bug or the code is inefficient, it will be a bug and it will be inefficient forever. However, if you wanted to, you could just create a new smart contract and tell people not to use the old one. In fact, this happens very often.